Andrew, when I retire, how much can I actually spend? You may not be surprised at how often I hear this, but you may be surprised at my response. Watch on for an analysis of a client situation who had this exact question. Definitely watch to the end where I give a few principles that may be applicable to your situation. Hey everyone, I'm Andrew. I'm a CFA charterholder and a CFP professional who spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. I'm also the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. And what I do is I take the learnings from those thousands of meetings and I give them to you so that you can apply them to your own situation. Today, I want to talk about a client that I had who retired with about $5 million, was a corporate executive. And they said, how much can I actually spend in retirement? And again, it may not be that surprising of a question to hear, but it's more nuanced than most people think. I can give a mostly correct answer in about 1 minute or less. I can give a completely correct answer, probably never. And so for this client, they had about $5 million in investable assets. This was during COVID when interest rates were much, much lower. And so an easy way to calculate this is you figure out a safe withdrawal rate from a portfolio, which at that point would have been somewhere in the 3% range. And so 3% is $150,000 a year for a 30-year retirement. 4% would be $200,000 a year for a 30-year retirement. And so I told them it was somewhere between $150,000 and $200,000 pre-tax, inflation adjusted. When we ran that, the very high Monte Carlo percentage, which means over 1,000 iterations of that spending rate and asset returns, they were okay, 85, 90, 92% of the time. Well, when they saw this, they then questioned, how much should I actually spend? And this is usually what happens. There are typically two angles that people come at from this. There is the angle of how much can I spend and have an extremely high confidence that retirement is okay. And so I gave them the answer initially for that. But their question was, how much could I maximally spend throughout retirement? And so this is when a good plan comes into play, because they had maxed out Social Security earnings. They're 60 years old. So in 7 years, they have about $50,000 inflation adjusted coming into play. Now, typically I discount Social Security for people over 60, and I may not have it keep pace with inflation. However, it still is an asset on their economic balance sheet. And so when you include that, that really changes the safe withdrawal rate of the portfolio, right? In addition, that withdrawal rate's assuming that you take an inflationary increase each year. And so instead, what they said is, we want to spend about $17,000 to $18,000 a month after taxes. So everything I quoted you was on a pre-tax basis. They said, we want a little bit more after taxes, but each year I'm going to evaluate the plan and see if I can hold off on giving myself an inflationary increase. And so that's exactly what they did. Well, throughout time, even though the initial Monte Carlo analysis was in the mid to high 60s, once we revised it to the higher income levels, income needs rather, over time, it went from the mid 60s to high 60s to the low 70s to the mid 70s, because a function of two things. They continued to spend the same level. So instead of it going like this, it went like this. And then they gave themselves a bump. Okay. Number two, asset returns outperformed expectations. And so what they said is, we will hold off on giving ourselves a raise. And furthermore, if our portfolio goes down, we would even be able to tighten the belt. What they did was a combination of a retirement smile and also a guardrails approach. Most planning softwares incorporate one or the other. My point in illustrating this story is that many times people do not fall holistically into one category. That's seldom the truth. The truth is everybody's different. Every situation's different. You can give a quick answer, but it's really hard to give the right answer. And I think the takeaway for you today is to understand, what income streams do I have? Because that changes the safe withdrawal rate of the portfolio. Are most of my expenses fixed or discretionary? The more discretionary expenses I have, the easier it is to implement a guardrails approach of the portfolio as it goes down, I decrease my spending. Or am I a person who likes to feel like they're beating the plan, right? And so I know that's a little extra money in my pocket every year. I don't give myself a raise, and I want to kind of battle with myself to see, can I outperform the plan projection? Or are you the type of person that wants to model out your life the way that you model out the financial plan and see where the inefficiencies are and make sure you're commensurate with what you're looking at? None of those are inherently right or wrong. And so that's why I say I can give you a mostly correct answer in about a minute or less. I can give you a completely correct answer, possibly never. But it's the combination of those approaches to retirement distribution and also where the current market is from a risk-free rate. 5 years ago, for a period there, a 10-year treasury was giving you under 2% per annum return. Well, that lowers the safe withdrawal rate of a portfolio. Now, 10-year treasury is giving you a completely different return. We're above 4, less than 5. And so it's dynamic, and you need to take all of those factors into account when you are looking at a retirement plan. So hope that story helps illustrate that truth to you. And until next time, talk to you soon.